FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 9/24/19. Well, you know, we're always trying to get new guests here, getting new perspectives, getting you new information from different sources, because it's so important. Because you know what they say about opinions. I won't get into it, but everyone has an opinion. Most of them aren't too great. This person, though, his opinions have been proven time and time again to be on the right side of the trade. I'm talking about Michael Pento. Oh, and if you've got an opinion and you want to run it by Michael, just email me, kl@kerrylutz.com. Michael, hey, you were with Euro Pacific for quite a while. Now you've got your own operation, Pento Portfolio Strategies. And if you want to check out Michael's work, just go to Pento, P-E-N-T-O, Port.com. Michael, it's a real pleasure to have you on the show. I've admired your work, followed your work for many, many years now, and you're kind of like a breath of fresh air when it comes to the mainstream financial thought. And hey, we're thrilled to have you. So when you're looking at the economy now, you're looking at what the mainstream says, what the Fed says about it. And then, of course, it's like a divorce. It's his side of the story, her side of the story, and then the truth. What's the truth here?
Well, first of all, thank you very much for having me on your program, Kerry. It's my pleasure, and it's been too long that we haven't been together. So, first of all, I just want to comment a little bit about the Federal Reserve as to why anyone still gives any bit of credibility to these people is beyond me. I mean, if you look back in those predictions over the past few years, going back even to the pre-financial crisis, I mean, they've never gotten anything correct. And recently, you listen to Jerome Powell, and then before him, first woman Fed chair, Janet Yellen, preach about the quantitative tightening program being like watching paint dry and running in the background. So they took the Fed's balance sheet from $800 billion pre-crisis, prior to the Great Recession, all the way up to $4.5 trillion. This was supposed to be temporary in nature. You remember Mr. Fisher from the Dallas Fed said that the United States would never monetize trillions of dollars of debt like some banana republic would do and have done in the past. Well, that's exactly what we did. But under the auspices of someday, under the illusion of someday unwinding all of these purchases, or at least most of these purchases, and taking the balance sheet from $4.5 trillion down to say around $2 trillion, because you have normal growth in the money supply and the growth in the economy over the past decade. Well, they took the balance sheet from 4.5 trillion to 3.7 trillion. That's it. And they had to abruptly stop because the Fed's QT program was far more pernicious than just running in the background and watching paint dry. Another false prediction from our central bank. As a matter of fact, it ended up clogging up the money markets and sending repo rates to the double-digit area. Okay, 10% repo, an overnight repo.
I wanted to talk to you about that.
Go ahead.
So 10% repo, that's unheard of. We've seen a couple of breakdowns in the repo market. The repo market goes back to World War I when the Fed started using purchases of securities held by banks to either increase liquidity or decrease it. The so-called open market operations. And now everybody does repos with one another, etc. What the heck happened to the repo market? It seems to me like there's a bank that lost its collateral or lost track of it, and somehow something happened here that nobody has given an explanation of. But to me, it seems like there's a big bank on its heels and can't either buy back its collateral or has lost the collateral, hypothecated it, MFS Global. There's something not right here. Am I imagining things?
I don't think you're imagining anything at all, Kerry. So what happened in 2008, everybody kind of learned a little bit about the repo market back then. We had banks, shadow banks, primarily taking their distressed collateral, mortgage-backed securities that were losing their value very rapidly, and taking them to the repo market. And nobody wanted this collateral because everybody knew their collateral was bad. And that meant that repo rates skyrocketed to the double-digit area a decade ago. Well, what happened recently is that repo rates, as I said, skyrocketed from where they should be, where the Fed wants this money market rate to be, around 2.25%, all the way to 10%. But what I find most shocking and most scary is that a lot of the collateral in itself is not insolvent yet. You don't see the big distress in LIBOR. You don't see huge distress in the junk bond market. You don't see big price moves in mortgage-backed securities. But rates in the repo market spiked anyway. And the reason I think they spiked is possibly twofold, but primarily it screams one thing very clearly, that liquidity in the repo market is gone. So because of Basel III and Dodd-Frank, there are no deep liquid markets for these bonds any longer. Banks do not want to make markets in these securities any longer. They just primarily act as non-principal traders. They're just matching trades now, buyers and sellers, okay? And that means that when, and this is not if, it's a when once again we entered into a cyclical downturn in the economy and we see mortgage-backed securities start to falter and junk bonds, there's $5.4 trillion worth of triple B bonds, junk bonds, and collateralized loans, CLOs, that are going to be defaulting in the next recession. That debt is going to be trying to be repoed. They're going to try to do repo, getting cash for that collateral. And when that spikes, now just imagine if you're repoing treasuries at double digits.
Yeah.
Okay. What are you going to get in the repo market? What kind of rate for overnight loans are you going to get when you start to sell or hypothecate your mortgage-backed security or collateralized loan obligation, which every bank knows is in default? It's very scary. There is no liquidity in the repo market any longer. And the only way the central bank of the United States, the Fed, can fix this, they can either stop paying interest on excess reserves or go back into another massive quantitative easing program to take the assets on the Federal Reserve balance sheet back up to $4.5 trillion. Maybe that will defray the anxiety in the repo market for a while.
So it sounds rather dire, huh?
Well, I think it's in some ways it's better than 2008 because this repo collateral, perhaps, other than with the exception of Deutsche Bank or HSBC, perhaps this repo collateral is still good, but the primary concern is there is no liquidity in the repo market, and the repo market is very, very critical. If you're a bank or a near bank and you need cash, the way you do it is by loaning your securities for a very short duration to another bank. But this is not, I'm not talking about primary dealer. That's where the effective Fed funds rate comes into play. That's where the Fed funds rate interacts with banks. I'm talking about the repo market, which primarily secured lending overnight for non-banks.
Right.
There's no liquidity there. And that means that your commercial paper market, your CLO market, your junk bond market is going to dry up just like it did in the fall of 2018, where no junk bond gets issued, zero. And the stock market dropped 30%. in a matter of weeks. So we were heading full steam into a recession and probably even carry a depression in 2018. And the Fed turned that around by stopping ceasing the interest rate hiking cycle. And then eventually what they did now is they're going back into QE. The Fed actually did launch QE Light by opening up the repo market in their last meeting. I don't know if that's well advertised, but they have actually gone back into a form of QE Light by opening up this repo facility and loaning money to the banks once again and expanding their balance sheet.
Wow. So they're monetizing debt effectively.
Yeah, that was the point. Thank you, Kerry, for reminding me about that. So the Federal Reserve did say that this was temporary in nature a decade ago, and we were going from 4.5 trillion back to 2 trillion. And guess what? They have permanently monetized about $3 trillion worth of U.S. debt, permanently monetized, expanded the supply of base money, which all loans are based off of base money.
Right.
They expanded the base money supply by about $3 trillion, which gives us and paves the way for the U.S. to head down the way towards a banana republic. Sorry, that's the truth.
That's it. So once you start buying your own debt and retiring it effectively, then where does that leave you here? I mean, we're in deep doo-doo here.
Well, we are. I mean, we see, the only saving grace is we're not some isolated banana republic like, say, Austria was or Zimbabwe was, or maybe, Argentina. So you can't see a currency. You won't see the U.S. dollar collapse against the euro or the yen per se. But we'll probably end up in a scenario more like Rome, where you just see the denarii collapse and you'll have 1,000% inflation rate someday. I mean, that's probably where we're headed. And I'm not being hyperbolic at all, Gary. You can have hyperinflation when you are the world's reserve currency. Just ask Rome. I mean, isn't that where we're headed? I have to say this, people will hear that and laugh. I'm sure they'll scoff at that. But that someday could happen. But you know what? I'm sure they scoffed at the fact that one day you would have $17 trillion worth of sovereign debt with a minus sign in front of it.
Could never happen, right? It'll never happen.
Why would anybody? There's $1 trillion worth of junk bonds in Europe that have a negative sign in front of them. Corporate debt. Why would anybody loan money to a corporation and hold it to maturity with a guaranteed loss in nominal terms, and after inflation really get your butt handed to you? Why would anybody do that? That would never happen, Mr. Pento.
Yeah.
But it did, and it is, and it's getting worse. I mean, we have the Central Bank of Europe, the ECB, just entering back into QE, even though they ended it in December.
Yeah, they never really ended it, though, did they?
I mean, they ended the expansion of its balance sheet. Ostensibly, the expansion of their balance sheet ended in December, but they were, obviously continuing to print over to roll over maturing debt. But now they're actually expanding the balance sheet in Europe once again, and they made interest rates, the deposit rate, more negative, from 40 basis points to 50 basis points. So I think, Terry, it's obvious to me, and it someday may be an epiphany to Wall Street, that this regime of negative rates and intervention by central banks can never end. Can never end. We have $250 trillion worth of debt globally.
Right.
That's a massive increase from where we were a decade earlier.
It's like triple or quadruple where we were.
It's up $70 trillion since where we were in 2008.
Right.
And we have a record amount of personal debt. We have a record amount of, that's in nominal terms, by the way, not as in percentage of GDP. corporate debt is now a record amount. It absolutely exploded in nominal terms. And we even have a record amount of business debt as a percentage of GDP.
Mm-hmm. Yeah.
The national debt went from 10 trillion to 22.5 trillion. And Kerry, it's rising by $1 trillion every year when we are not in a recession. So the thing I'm trying to get across to you and your audience is that interest rates can never be allowed to normalize because we cannot service debt given the great augmentation of the amount of debt outstanding and the way where the pace we're adding to it is exponential. How in the world can interest rates ever be allowed to normalize, Kerry? Which means that central banks can never take their foot off the gas pedal and must continuously monetize all of this debt forever and ever. Amen. Amen. And if that doesn't lead to someday the complete lack of faith in fiat currencies, I mean, I'll eat my hat, as they used to say. It'll eventually cause people to understand that the purchasing power of fiat dollars is going to become worthless.
Yeah. And I was expecting that to happen 10 years ago. I was totally wrong. They managed to pull the, snatch victory from the jaws of defeat, I guess is what I was saying.
Right.
And so it's like, I'm wary. I still believe in holding gold and gold-oriented securities, mining stocks, etc. But nothing ever happens exactly the way you think it's going to happen is my point.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Well, I run a money management firm here, and I have a pretty sophisticated algorithm. I have a 20-point inflation, deflation, and economic cycle model that keeps me and my investors on the right side of the trade. So the cyclical trade is very important. So I don't do someday investing. I don't say that someday the dollar will collapse and gold's going to go to a record high and just, buy and hold those securities, or, just invest in foreign stocks only, or just short bonds. I mean, all these things could eventually and should eventually happen, but you have to know what the cycle is. So, for instance, I wrote a book in 2012 called The Coming Bond Market Collapse. Did very well. It has a lot of good points in it, but I never imagine in my wildest dreams at the time of its writing that we were going to have negative interest rates in corporate debt. I never thought of it. I just realized there was a bond bubble. Central banks would never be able to stop the manipulation of interest rates, and one day this bubble will explode. But it might surprise people to understand that my portfolio has been long bonds for the past year, because you have a situation of disinflation and slowing global growth, which is good for bonds. Now, someday, that will explode. In fact, I heard somebody on CNBC say the other day that the bond bubble exploded already. I had to laugh. I mean, this is sophomoric at its highest level. When the bond bubble explodes, and prices collapse and yields rise, they will not go from 1.7% on the U.S. 10-year note to 2% on the U.S. 10-year note.
Yeah.
They will go to the average yield on the U.S. 10-year is something like 6.5%. That's the average. And bubbles never burst innocuously. So you imagine when this bubble really bursts, and it's going to burst because we finally inculcate to investors' minds that we have achieved inflation targets. Inflation targets have been achieved, they've been exceeded, and they will continue to grow intractable. That will be the catalyst for the bursting of the bond bubble, the sovereign bond bubble. And at that point, yields aren't just going to rise slowly, innocuously to 2%. They're going to rise back to their normal level, historically normal level, and then go beyond that, as all bubbles do.
Yeah.
You're talking about perhaps double-digit rates for the U.S. 10-year note. Imagine that. Well, that's what that's going to do for the real estate market, to the stock market. That's what's going to happen. One of the asinine goals of central banks is to target inflation at 2%. We are at 2.4% core CPI year over year. So they've exceeded their goal and have overachieved on their goal. But someday that's going to blow up the bond market. Of course, the other thing that could blow up the bond market, Kerry, and this is not the sovereign bond market, but the junk bond market that I mentioned before. In the United States, $5.4 trillion with the triple B and below. That's going to blow up when we enter a recession. So you might see money flow into sovereign debt at that point. But can you imagine what's going to happen when the junk bond market completely implodes and you're trying to repo CLOs and leverage loans and junk bonds, and there's no bid out there, there's no money for that if you don't pay at least 20%, or maybe the money's not there at all? This is what's in store for us down the road, and you have to be aware of this because we are not in the buy and hold maybe 1950s or the 1960s or 1940s, 50s. You can't just buy and hold a basket of stocks that mirror the S&P 500 and maybe offset it with some bonds. It's not going to work.
No.
Not when both of those assets are in a massive and epic bubble.
So it's rough sledding ahead, hey?
Well, we haven't gone anywhere in the stock market in the last, 18 months. I think you talk about rabbits and pulling things down, kicking the can down the road or punting. There's one more trick that they can pull, and that could be Donald Trump engineering the most massive and beautiful trade deal that the world has ever seen. If he does that in early October, I think this could extend. By the way, that's a change in fiscal policy because tariffs are taxes. My model will pick that up, and perhaps we can extend this for a little while longer. But eventually what you're going to run into the fact that we have records amount of debt that are growing very, very quickly. Interest rates are in the basement of history. There's not much room left for central banks to do anything about lowering borrowing costs because the cost of money isn't the issue. We're going to have another recession. We're going to have eventually intractable inflation. And that's when the bond bubble blows up. And that's when the poop really hits the fan. But until then, we can continue this mirage. But remember, it is a mirage, and you must be very, very careful.
Yeah. Eventually the mirage disappears and you see you're in the middle of a desert and there's no water for 1,000 miles, right?
That is the case. There'll be no central bank coming to your rescue. The only thing they can do, think about this. If the central banks become successful in creating inflation and interest rates start to spiral out of control, tell me what they will do in Japan, for example. What are they going to do? They could either print more money and make inflation grow hyper, or they could stop buying all the bonds issued. And you can imagine when you have a minus 50 basis point 10-year JGB, and you know that the Bank of Japan is now going to fight inflation by stopping to buy bonds and selling some of those bonds, where do you think that yield's going to go regardless?
Yeah.
I mean, it's not going to go from minus 50 basis points to minus 10. Because if Japan had to live in reality with a quadrillion yen in debt, what do you think the interest rate should be if your economy isn't growing and you can't service your debt at all and you must default upon it? You think you would accept minus 50 basis points on a 10-year JGB? I don't think so.
That's nuts. It's nuts.
Yeah.
But we've seen this over and over again. It keeps getting more absurd. Can the system exist as it's currently configured with widespread negative interest rates? Is that possible that it can continue on its merry way and nothing goes wrong?
Well, banks aren't, if you look at European banks, they're not doing all that well. primarily because their deposits they keep at the ECB are losing money.
Mm-hmm.
And they can't loan this money out because nobody wants it because we're in a debt-disabled world.
Mm.
So I don't see how the world economy can prosper with negative yielding debt. I wrote about this a little bit. It's sort of like, you have savings. Joe Consumer has savings. What he could do is he could spend all those savings now,
Mm-hmm.
or what he could do is give them to somebody else and guarantee that he's going to lose money in nominal terms, and even more so in inflation terms. So what's going to happen is, logically, intuitively, if you have the choice to save money and lose it, or enjoy all of that purchasing power now in the present, what would you do? Well, you would have to consume. I believe you would reach the conclusion that you should consume that savings now. So you'll have a very massive increase in the velocity of money.
The crack up.
Money will start to lose its purchasing power.
Mm-hmm.
The creation of base money will be increasing at this time. And like I said, you could get a scenario where intractable inflation starts to run intractable. And then you'll get that spike in bond yields, regardless of what the central bank can do nothing.
Mm-hmm.
Nothing.
Yeah.
Because if they say to you, I don't like the central bank of the United States or the ECB or the BOJ says, I don't want bond yields to rise any further. I'm going to buy every single Treasury, JGB, or European bond that's issued. They could say that, but then every other bond that they are not buying, every municipal bond, anything that has a fixed income rate to it would collapse.
Yeah, for sure. So
does this sound like a viable rationale from any individual? I've given up thinking that these people live in a rational environment. Rationally speaking, Kerry, what they should do is allow a recession to run its course, purge the system of all of its excesses, live in a world of reality where interest rates were dictated by the supply and demand of savings, and then let's see what happens.
And get rid of Fannie and Freddie, right? Get rid of them. There's no reason for them to exist in this world.
There's no reason why. Exactly. There's no reason why a home price to income ratio should be almost 5-to-1, which is just below where it was at the height of the housing bubble. You wonder why the housing market isn't gaining a lot of traction, because first-time home buyers can't afford that. They can't afford the down payment.
Yeah, and let the colleges. Everything has to collapse. That's what it comes down to. The housing market, the auto market, the college market, because they only get these prices because of the debt. If there was
credit
no debt,
cards, student loans, auto loans, all of these things have to but tell me, what politician?
No.
And I voted for Donald Trump. What politician? Donald Trump gauges his administration's report card on the stock market.
No,
what politician?
Never going to happen.
Republican or Democrat will stand up and tell you we're going to have a 2-year depression. The stock market is going to collapse. You're going to lose money in bonds and stocks
and real estate.
And on the other end of it, we're going to have a viable economy.
Yeah. I always think, Michael, like if there was no Federal Reserve, if there was no debt-based economy, a car would go for like $3,000, what it went for in the 60s. A college education would go back down to $50 a semester, and a house would be a decent house would be $15,000 or $20,000. It's only because of the run up in debt that these prices have gone up. Because if you couldn't borrow to buy a house, then you'd have to pay cash, right? And the price would be much, much less because very few people could afford to buy houses at the current prices for cash.
We have a debt-based monetary system, as you're well aware.
Sure.
Correct. And that debt has been monetized because it can't be serviced. So
and securitized.
You're exactly correct.
And securitized and sold off to every unsuspecting investor on the planet. Well, hey, this was a great first interview, Michael. I really appreciate that we finally got to connect. And you're definitely going to want to take a look at Michael's site. It is pentoport.com, pentoport.com. Any questions? What do you think? Can the debt bubble go on much longer? Ask Michael. Send us an email, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Make sure if you're listening to this podcast or you're on YouTube that you please like, share, and subscribe it. That's the way we get the message out because the powers that be in the technocracy are not getting this message out. And it's a message that so desperately needs to be heard. Michael, just keep up the great work. Thanks so much for coming on, and we will definitely talk to you again in the not too distant future.
Thank you again, Kerry. I look forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.